What's going on, everybody? Jeff here. Welcome back to the channel. A bit of a choppy day inside the market. However, what I want to talk about is there was a new model that was released that tracks real GDP growth by the Federal Reserve Bank of Atlanta. Their expectations have vastly changed over the last few days. I want to talk about those numbers, how it affects the short term, what the chances of us slipping into a recession is. Now, I know some of you already say it is, inevitable by looking at inflation, seeing how the way the Federal Reserve is raising interest rates and how they're being able to combat that, it is clear to me as well that we are headed towards a recession. However, we really need those actual numbers to confirm that. I also want to talk about now that we are heading into the fifth month of a bear market. Okay, it began back on January 3rd. The time frame gets tracked by its most recent high. How does falling into a recession affect the time frame of bear markets? The average bear market lasts between 8 to 10 months. However, when we do slip into recession, that time frame is much longer. So I want to talk a little bit about that, and also about the interest rates. Okay, because we're a lot closer before the Federal Reserve actually stops raising interest rates and starts to lower interest rates. Okay, so if you haven't heard about the potential of that happening, it's really sooner than later, you're going to hear it first, because that is going to be the only way to save the economy, from historically speaking. All right, eventually the demand slowing will naturally cool off inflation. You've watched oil, take a huge dip as of today. All the energy sector is really pulling back as well, which obviously we know, gas, energy, and food, which utilizes fuel to deliver those goods. It's really those numbers of inflation is accelerated by gas and energy. So seeing that come back a little bit, the demand slowing down is really what's going to pull back inflation. And however, like I said, the only way to save the economy is going to be, lowering interest rates. So for the long term, we're going to talk about that. And the reason being why I'm really trying to talk about long term a little bit more is so you have enough time to prepare. So you're not jumping back into the stock market, when we're already in the euphoric stages. All right, you're preparing now to be able to ride the entire next wave to the upside. All right, so let's get right into it. First off, here is the article, the model that was released from the Federal Reserve Bank of Atlanta. So previously, the estimate for real GDP growth was negative 1%. However, after the manufacturing ISM report was released on the 30th, that model has changed to a growth of a negative 2.1%. Now, anything in the negative is going to officially put us into a recession. The bigger picture is that the real gross private domestic investment growth decreased from a 1.7% to negative 13.2%, and respectively 0.8% to negative 15.2%. And the reason why those numbers are important, if you're unfamiliar with them, is just know this: the gap is becoming wider and wider. Okay, you look here, that's a 15% difference. Okay, so seeing that gap just widen just goes to show that getting out of quarter two having positive growth is really becoming slim to none. Now by the time the media starts talking about we're in a recession, we've already been in one for 4 to 6 months. Okay, so let's talk a little about this bear market. All right, and I'll go over to it right here. The bear market did officially begin on January 3rd when it hit its all-time highs. We talk about 10 things you need to know about a bear market. Okay, is one, there's been just as many bear markets as there's been bull markets. The average length of a bear market is 290 or 89 days, or about 9.6 months. That does change, like I said, whether we've had a recession. That does change a little bit based on inflation. However, the average length of a bull market is 991 days. So the point behind all of this is, if you've been chopped up by playing intraday plays, if you haven't been chopped up, please check out the link down below. I come up with a pre-market list every single day where there's opportunities on both sides of the market, whether it's moving to the upside or the downside. But if you've been chopped up, if you're still bag holding, if you're looking to start building positions, think about that right here. Once we get through this, you've got almost 1,000 days, to almost 3 years, to over 2.5 years, to be able to ride the upside. All right, and the average gain is 114%, meaning this is where a bulk of your wealth is going to be built. That's why I'm really trying to emphasize on preparing for this in the future. Now let's talk a little bit about some of these numbers, okay? The average declines and so forth. And as you can see, I have some of these highlighted, and I'll talk about them in just a moment. So we have the average at 289 days, and we have the average decrease is about 35%. We're sitting around 22, 23% But what I have highlighted right here is the 70s and early 80s, and you have a little bit of a longer time frame. And the reason why I have these highlighted is because in the 70s we had rapid inflation. Now things were a little bit different. Okay, interest rates were astronomical. I remember my father bought his first home. I think it was in 1982, and his interest rate was 13%. He thought that was a great deal. So things are a little bit different. But the point of the matter is, it is a little bit similar of a time frame that we're in. While there's differences, of course, there are also a lot of similarities. So I do see us potentially getting into, especially if we hit some of the recession, we're going to be a little bit longer than this, 289 average. Okay. So keep that in mind. Let me jump over to the chart right here. I'll jump out to this bigger time frame for you that I was looking at even earlier. Jump over to the daily. Hang on just a moment. I wasn't. And you can see here, okay, I'll even scroll down a little bit, that from where we hit this to where we are right now, we are down currently about 22%, and we are already 182 days in. So on the average bear market, we're already 2/3 of the way through. Okay, now this does change when you're looking at forward PEs, and if you're thinking about what stocks to buy, massive, there's a lot of differences, and we'll get into some of that in the future. I'm talking about just preparing as of right now. Now, when we talk about interest rates, okay, they had mentioned that in June there was going to be a 75 basis point. In July, it was still on the table. As you can see, 83% of the market is priced in right now for a 75 basis point hike. Now, I can't drag this out to anything further than February 23rd. However, I have seen some expectations for late 2023 and 2024, okay, especially when correlating this to the bond market, is they're actually predicting that they're going to lower interest rates. Now, like I said at the beginning of this video, okay, and like Jerome Powell had even stated, all right, in his last Senate Banking Committee, that he doesn't believe, okay, that rising interest rates is going to directly cause inflation to decrease. Okay, he actually stated it's not going to make the price of fuel and groceries any less, and he got a lot of slack for that. What is going to make that go down is the fact of lowering the demand. If we cannot increase the supply for a million different reasons, the only way to get that pricing power and that buying pressure to decrease is by lowering demand. And how they can do that is by potentially taking some money out of circulation as of right now, which they're doing at quantitative tightening, lowering their balance sheet and so forth. However, this is a recipe for disaster. Okay, when they're quantitative tightening into a slowing economy, the chance of a recession is very, very likely. Now, how do we get out of a recession? Well, think about how we got out of the last two recessions, going back to the financial crisis in 2008, and just actually what happened with COVID. Okay, it was quantitative easing. We're lowering rates. They're supporting the bond market. They're buying mortgage-backed securities, treasury bonds, and the government is keeping everything afloat. So going based on history, what is going to happen again when we slip into recession? The same exact thing. Now, we've seen these V-shaped recoveries. Okay, we've seen some of the bottoms form when PE ratios, buyers already step in. We saw the V-shaped recoveries as well. This is what the time to prepare for. And I've always said this, okay, that I'd rather be a little bit early with room to add than be late to the party. Okay, which means chances of timing a bottom are slim to none. You've got to get very lucky. Okay, you can try to do the best you can for chart analysis, economic analysis, and so forth. But over a larger time frame, the chances of timing a bottom can be very early. So that's why we start prepare for this, start understanding what is happening from a financial standpoint, from an economic standpoint, and being able to slowly add and build into positions for the long term. Okay, once we get through this, you've got at least 2.5 to potentially 5 years, if not longer. One of the bull runs we were in before COVID went all the way from that 2008, 2009, all the way up to 2020. So we had 10 years of massive growth to where you can build a huge chunk of your wealth. If you're a little bit older, think about retiring in the next 10 to 15 years. This is the time to prepare for it. So guys, that's it for this video. I'll see you in the next one.